Hello all, I am Dr.Supriyaa, Assistant Professor at Department of Commerce at Government First Grade College, Hesarghatta, Bengaluru Rural, Karnataka. It's a pleasure from my end that DCE, Government of Karnataka, is given a platform for us to go for digital learning. The topic of the presentation is Introduction to Financial Management. As we know, finance is a vital functional organ of the firm. If finance function does not operate well, the whole organizational activity will be ruined and may paralyze the activity of the firm. Hence, finance function should be well organized in a firm. Finance function is controlled by the top management by considering the survival and the growth of the firm. So let us understand the meaning of finance. According to Paul G. Hastings, he defines finance as finance is the management of the monetary affairs of the company. It includes determining what has to be paid for raising the money as the best terms available and devoting available funds to the best uses. As we know, finance function can be broadly divided into two parts. That is the routine financial matters, that is the day-to-day financial transactions, and the special financial decisions or the function, that is financial planning and budgeting, the profit analysis, the investment decisions, the accounting part, that is the financial accounting, cost accounting, and internal audit too. As it's well said in the pic which is there in the slide, that is, beware of little expenses, a small leak will sink a great ship. Further, when we move on to the next slide, we will understand the definition of financial management. According to Philippitas, the financial management is concerned with managerial decisions that result in the acquisition and finance of long-term and short-term assets for the firm. As such, it deals with the situation that require selection of specific assets or combination of assets, the selection of specific liability as well as the problems of size and growth of the enterprise. The analysis of these decisions is based upon the expected inflows and outflows of funds and their effect upon the managerial objectives. As FM is the part of managerial activity which is concerned with the planning and controlling of firm's financial resources. It is an area of financial decision making where it harmonizes the individual motives and the enterprise goals. Yet it also deals in tracing out the sources of raising of funds for the firm. Why do enterprises need financial management? Let us know in detail. The first and foremost need, that is the forecasting and estimating the requirements of capital. Here, the forecasting and estimating, I think it is two faces of a same coin, where forecasting is needed in order to do the estimation process of funds, that is the capital. So funds are needed because in order to establish the industry, both for meeting the capital expenditure and revenue expenditure, the capital is non-recurring in nature, whereas the revenue expenditure is recurring in nature. We need to consider both, and the expansion and to increase the production to meet the demand of consumers. It's needed even at the growth stage and at saturation stage. The next need is determining the capital structure or the composition of capital. As it's well said, the best capital structure will ensure wealth maximization. Hence, the financial manager's task is to select the right type of sources of funds at the right time, at the right cost, as each financial instrument is associated with different types of cost. As you know that the very next need is choosing the sources of funds, where I'll be clubbing the second need and the third need. So capital structure, the best capital structure the FM has to design in favor of the enterprise, which whether it is a small or the medium or the long or the big enterprises, they need to manage the sources of finance and the capital structure hand in hand. The capital structure need to be designed in such a way that it has to be proportionate in handling the things, because irrespective of the shares, that is equity shares or the preference shares or the debt or the borrowings, the proportion should be to manage the show in the future, considering the profitability and the return. So hence it has to be more vigilant in selection of this. Why? Because these shares or the debts or the borrowings, it costs. Because in case of preference shares or the equity shares, the dividend has to be paid to the shareholders, whereas the debt or the borrowings, the interest has to be paid. Hence, both have to be managed. The very next need is making optimal use of the funds. So optimal means the maximum benefit. So after choosing, after forecasting, after estimating, then determining the capital structure, then after choosing the best proportion of capital structure and the sources of finance, definitely the next task the FM, the financial manager, does is that is optimal use of the funds. So it's an obligation of financial manager to distribute the funds to capital expenditure, revenue expenditure, and before that I think he need to evaluate the different proposals of project which must be made before making a final decision on investments based on the risk and the return. Both are interlinked when it comes to any enterprises, whether it is a small or the medium or the big. The next need of financial management is administering the income of the business and its allocation. This is also one of the vital tasks of financial manager, where he is expected to watch the performance of business, which is measured considering the profitability and the ROI, that is a return on investment. The next need of FM is managing the cash or the liquidity position. It's the prime objective of a business where liquidity plays a role. So increased liquidity builds the firm's ability to meet short-term obligation towards creditors or the bankers, because bankers or creditors lend based on the creditworthiness. Higher the liquidity, the firm's ability increases to borrow the money from the creditors or the bankers. The next, that is analyzing the performance of finance. So what is analysis? Analysis again is evaluating the financial performance and exercising the financial control. Here, evaluating the financial performance that we do by looking into the final accounts prepared. So we check in and we have certain tools, the financial analysis tools or the management analysis tools to analyze. There is a ratio analysis or the comparative or the common size or the trend analysis. You have various tools to analyze the performance of the business. When it comes to exercising the financial control, here definitely the control tells that it is you are going to compare the standards with the actuals. So whenever there is a deviation, I think the measures have to be taken and remedial action has to be delivered. Fine. I think these are the key points which I have enlisted here, because forecasting is needed, determining the capital structure. We need to choose the sources of finance, so optimal use of funds, administering the income, managing the cash, analyzing the performance of finance. I think, don't you feel that there is a need for financial management? When we go further with the slides, we need to check out the focus point of FM, that is the financial management. The focus points are, that is the profit maximization and the wealth maximization. I'll just make an effort to give the bird's eye view of both the terms. There is a profit maximization. It denotes the maximum profit to be earned by an organization in a given period of time. Whereas the wealth maximization, it denotes the value of an asset in terms of benefits it can produce. Any financial action can be judged in terms of the benefits it produces less the cost of action. Yeah, we know that. I think just by abruptly stopping here, there might be the eyebrows up here, but I have made an effort to give the bird's eye view of it. So, the concluding role here. Yes, FM is needed. FM, financial management, is required to do the capital structuring, capital budgeting, working capital requirement, and the dividend policy, investment policy, financial policy, because these are the three key roles, the significance made by the FM, because we need to do the investment policy or the policing too, financial policy and policing too, and the dividend decision making. So FM involves estimation, acquisition, and administration of funds of any kind of meeting the needs and the objectives of the business. So FM is required. So the finance is the lifeblood. So we need to manage the show. And when we just talk about finance in layman's language, it's the money when it is required. So for any enterprises, finance is the lifeblood. So managing it is one of the key and very vital point in the organization. It can make or break the organization. So thank you for your patientful listening.